biggest myth you've ever heard about investing?
Biggest myth in investing, I think, at least if you look in recent history, is sell in May and go away. So I looked at this over the last decade. It's only worked in 3 out of 10 years. So I think the recent history tells you stay invested.
It's actually recently that value investing is dead, especially in this innovative and disruptive world that value investing doesn't work anymore, and that's not true.
In our space, it's all about real estate is tied directly to interest rates, and the reality is that I've seen real estate perform in the 1980s when you had very high relative nominal interest rates. So for us, it's a yield play. Look, as far as we're concerned, all investments are related in some way to interest rates. Some are more sensitive than others, but to say that real estate is the only one or the most sensitive to interest rates and yields, we think is flawed. It comes down to real estate fundamentals, supply and demand. And when I started out, the narrative was that real estate was a hedge against inflation. Now it's a yield play. So investors are convenient in the narrative. And what we try to do is just look for the right fundamentals of what you're investing in. More demand from tenants than there is supply, and you'll do okay.
Probably that investing is gambling, like going to the casino. It can be if you approach it that way. But I think if you methodically settle down, follow a process and invest carefully, backing the right company, the right management team, it's not gambling, it's investing.
Look, I think that markets are everywhere and always efficient. Having worked for a couple of decades through some pretty extreme market cycles, and for some top tier active managers, I can say I can have lived through plenty of moments when markets haven't been efficient. It's not to say it's easy to pick those moments in real time, but the difficulty in picking those moments is usually down to our own psychological deficiencies and external constraints, whether that's liquidity risk or short-term performance. But certainly saying it's hard because markets are efficient, I think, is a big myth.
That equities always go up.
Plain and simple.
Exactly. I mean, everyone says to make more return, own more equities. But there's plenty of periods. 2000 to 2010, equities basically went sideways to down for that decade. So, if you've got a very, very long-term horizon, back equities. If not, I think you just need to be a little bit more circumspect about how confident you can be in equities rising.
The myth I hate is that the share market is a casino, because I find it quite offensive. In terms of the fact that it's my job and that's what I do every day. And I do recognise there is a trading element to the casino, the casino that can be the share market, and there is obviously inflated bubbles that happen through the market, and so that can put people off. But I think if you do your homework and do your research into companies and you follow those quality companies, then it's a very good place to invest your money.
For those investors that are watching, if there was one piece of advice, a tip that could help them be more successful, what would that single piece of advice be?
Yeah, so Nobel laureate Daniel Kahneman wrote a book called Thinking Fast and Slow. And he says that we evolved to try to conserve energy and make fast decisions, kind of snap decisions with a lot of assumptions. And that's really good if you're trying to outrun a tiger. But if you're trying to make money from investments, then you need to be thinking slow. So you've got to find out for yourself what kind of individual processes or habits you need to have so that when you're actually making those decisions, you're in slow thinking mode. Now, we don't like to think slow because it's very resource intensive and we evolved to be kind of lazy. And so it's a lot easier to just make fast decisions. It feels really good. But I think, personally, that's a really important thing, is to find a way for yourself to get into your slow thinking mode.
There's more than one way to skin a cat. And what I mean by that is that I don't think it's right for anybody to be too prescriptive. I think you've got to find a style and an objective of what you're trying to achieve from your investing. If you want to gamble and try and pick the next, Google / Amazon / Apple, etc., so you should. But for every one of those, I can tell you there's 50 failures. It's very good that the market picks the winners and forgets the 50, 100,000 that fail. So if that's what you want to do, be realistic. But also, as I say, there's other ways of investing for the long term, which provides a more secure path to wealth. And that's the way we look at it.
Always do your own work and try and understand what you're investing in. Try. I see too many people today, everyone's a Bitcoin trader.
And when you actually ask, and everyone's made money on Bitcoin, by the way. Suppose I don't know who the loser is, but everyone's made money on Bitcoin. And it seems like everyone is treating it as an investment. But when you actually ask people, well, so can you explain it to me? There's not a lot of behind it. I think it's very important to understand what you're investing in, do a little bit of work, also understand what your risk tolerance is. Are you open for volatility? Are you a risk seeker, or are you more risk averse? That's really important also.
My advice for investors next decade, how can you be most successful? It is very simple. If you don't understand something, don't invest in it. If you want to understand it, want to invest in it, find someone that does.
I think one thing of the many things I've learnt along the way, it was drummed into me at an early age, and it's so true, and that is that in matters of finance and funds management, one's got to be patient. Investors need to be patient. They need to take in some cases, a longer term view. In other cases, when a story is momentarily derailed, you need to hold the line and be patient with the company. If you're backing a business that is well managed, that's conservatively funded and well structured and not overly risky in terms of how it's funding its operations. If you're buying a business or a stock that is exactly that technically, if you look at a chart, looks like it's technically behaving well, that has a sound model and a sound market opportunity, then you should hold it. So it's really the virtues of patience. Very easy to take a quick profit and move on. Very easy to lose patience with a stock because the bloke next door's bought a stock that's doubled in the last week and yours hasn't. I mean, they're natural human inclinations to want to jump off, but you need to be patient and you need to sit and nurse stocks. And who knows, sometimes if you wait long enough, you will get multiples of your money rather than just a quick doubling of your money. So I think the most underestimated attribute for a good investor is patience.
If your objective is to do a certain thing, focus on doing that. If you're looking to achieve a particular rate of return, build a portfolio that does that. Don't worry about what everyone else is doing. Don't worry about sort of missing out on something that was better. If you're achieving through the strategy you implement what you've actually set out to achieve to meet your goals, then I think that will deliver you the best results over the long run.
Be patient, be diversified, but also, our big philosophy is the fact that share prices follow a growth in companies' earnings. Okay, so very focused on what are those earnings drivers for the companies. What is the earnings growth outlook for that company? And if you see any of those drivers wavering, or you see obviously a downgrade, then move on, find something else to invest in.
I think the world is a big place. I think cast your net widely and broadly. When we have a look at investors' portfolios, there's a very large degree in Australia of I think a home bias in portfolios. I think that's going to hurt over the long term from here, particularly when you look at that home bias and what it's exposed to. So a typical portfolio, that we might see on the retail or wholesale side would be a portfolio of cash, term deposits, a couple of hybrids, some blue chip high div paying funds, and probably investment property. That's like a really typical portfolio. And at face value, you look at that and you say, that's pretty well diversified. You've got some property equities, got bond-like instruments in there. When you really take a look, that's a hugely concentrated bet on the Aussie housing market. It's either directly through the property or indirectly through the banks that fund them. So having that home bias is a really concentrated bet on an asset class. You have to ask yourself, am I that highly convinced that the prospective returns from that are that attractive that I shouldn't be looking elsewhere and diversifying that? So I think there's a real opportunity in Australia. The one piece of advice I would give would be, the world's a big place, diversify that home bias risk. Portfolios can be attractive that construct really attractive income streams and risk return objectives without having that massively concentrated sort of home bias bet.
The bucket in Australia.
Yeah, exactly.